Let's focus on the earnings season so far here around Europe. Piers Curran is a head trader at Amplify Capital. He joins us now. Richard, you're still with us. I want to look at this on a broad perspective. But absent today's numbers, it seems to me there's quite a significant gap between earnings beats in Europe and those in the United States. If I've got the numbers right, Stock 600 beats are about 59%, whereas S&P 500 beats are about 84%.
Yeah.
Is that about performance or about conservative estimates?
I think it's possibly both, actually. That's the simple answer to that. Conservative estimates have been the case, and the United States of, the earnings season, if you look at the stats, is sensational, but how much of that is to conservative estimates? So, and on the performance side, I think, just in terms of the general macroeconomics, I think the Eurozone is lagging behind the US, so it's as simple as that, really.
And I suppose the characteristics, both market share is a lack in top-line revenue growth, and any indication as to how long cost-cutting can continue to expand earnings, or I shouldn't say expand earnings because they are contracting on a year-on-year basis, but improve, beating estimates, I should say.
That's right, and that's what it's all about. I mean, cost-cutting, great. I mean, it worked. That's what we wanted in quarter two. Quarter three, you can't cost-cut forever, as you're saying. If this economy is going to recover, the amount of sales these guys are bringing in has to increase, and that's the way we're going to move forwards. Quarter three, so it's been, the Eurozone's been disappointing because if you compare it to the US, but still over 50% have beaten. So let's not be too pessimistic here.
And Piers, let's not make the mistake of focusing too much on the fundamentals, because it strikes me that the last 9 months of market activity have not been about the fundamentals. They've been about a wall of liquidity that's been provided via government intervention and central bank activity. And it hasn't stopped, and we're going to find out this week that the central banks are going to put even more money into the market ultimately, aren't we? I mean, do you see any reason as the head of trading to call your guys off and say, hey, let's run for the exits here and sell our positions because we now know this market's going down? I don't think so. You're going to be buying, aren't you?
I'm still buying. This dip we've had in the last sort of 10 days or so, a lot of people have been talking about it. It's not as big as most people have been waiting for, and I don't think this dip is going to get any bigger. I think if you want to get long, you need to get long now. I'm talking about equities. I think that the next leg higher into the end of the year we will be making new highs for 2009 before Christmas.
Is there anything that you think at this point on the margin could prevent that from happening? I mean, the green light seems to be up as far as I can tell. Yeah. But what are the risks?
We had a bit of a scare, with the FOMC statement last night. The reason why markets got so nervous last week, the reason why we dropped off, it was the worst week since July for stock markets. The reason for that was nervousness ahead of the FOMC statement. They were worried that the FOMC were going to start to hint they're going to remove stimulus. The market's not ready for that, and last night the FOMC kept their statement as it was. They're not looking to raise interest rates anytime soon. Extended period, that was the two words we were looking for in that statement. So interest rates to remain low for an extended period. It calmed the nerves. So I think if the central banks are too quick to suggest and talk about removing stimulus, that will trigger a nervous reaction in the market.
Look, we've had a flurry of rotation that's taken place around this kind of scrabble of bulls and bears battling it out over what happens with the liquidity. Yeah. It seems if you take that Marks and Spencer gain yesterday as any indicator, the money is going back into the cyclical story. So it's banks, it's retailers, it's anybody that's going to benefit from this immediate money push.
Yeah, and that's been the case for the last.
Is that what you guys are doing?
Yep, absolutely. And we will be till the end of the year. We don't think there is any reason that the risky asset play. We think that's still the strategy to have.
You want to come in?
No, I think I share that story. Although I'm among the nervous people, I have to say, and you can read. Maybe I read too much of the U.S. commentary, actually, in fact, but and maybe I read the wrong commentary. But a lot of what I read is very, very doubtful about the medium term.
Well, where do you see the implications of rising equities on consumer confidence? Because ultimately, in the United States, the weakness $8 export scenario is going to continue to drive S&P 500 earnings and performance. And I think a lot of Americans, and indeed Europeans and people here in the UK, are going to look at rising asset prices and be mystified because they're not going to see concurrent growth in their own economic lives. And you wonder what sort of implications that has.
We're going to see growth in their personal net worth, that's for sure.
I'm not sure that people are invested in Europe in the same way as they are in the US.
That's true. I thought you were talking about the US.
I beg your pardon,
but
and with a weak dollar, your actually purchasing power declines while your net worth rises.
But people don't look at that.
Yeah.
People don't look at that. They look at their portfolios. Real estate starting to come back.
That's true.
Equities coming up. That trough in personal net worth has I think, been passed.
So Piers, where do the commodity stocks sit in this? Because there's some doubt, it seems to be, in the market as to whether they should chase the commodities along with all the other cyclical stuff.
Yeah, that's an interesting question. Obviously, gold making new all-time highs yesterday off the back of India buying, what was it, 200 tons of bullion, I think it was. I think gold's going to rise. I think it's got plenty of upside left for a number of reasons. I think that will continue to rise throughout next year as well. Oil is a little bit different. Of course, it's tied into the economic recovery story like everything else. And
thanks very much for coming in. Good to talk to you this morning. Piers Curran, Head of Trading at